Ladies and gentlemen, good day and welcome to the Q3FY25 earnings conference call of Sansera Engineering Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. B.R. Preetham, the Executive Director and Group CEO. Thank you, and over to you, sir.
Thank you. Good morning and welcome everyone. Thanks for joining this call. On this call, I'm joined by our CFO, Mr. Vikas Goyal, Mr. Praveen Chauhan, our Head of Corporate Strategy, and Mr. Rahul Kale, our COO, along with our Investor Relations Advisor, SGA. The results and the presentations are uploaded on the stock exchange and company websites. I hope everybody has had a chance to look at them. Starting with our quarterly update, we delivered a decent performance in Q3 of FY2025 with a revenue of rupees 7,278 million and an EBITDA margin of 17.5% with a PAT margin of 7.7%. I would like to highlight that generally Q3 is the weakest quarter for the overall auto industry, and I think we have delivered this performance despite a challenging external environment and a very strong corresponding Q3 in the last financial year. Following our QIP, the balance sheet continues to remain strong with surplus cash standing at almost about 4,969 million. With this, we are well placed to expand our capabilities in line with our order book of new business. During the quarter, the overall domestic demand trajectory remained moderate post-festive uptrend. That said, January began on a positive note and the outlook for the year continues cautiously optimistic. We expect some inventory correction to take place due to OBD2 Phase B in the coming quarter. As per S&P Global's 2025 forecast, the global auto sector remains focused on managing production and inventory levels in response to the regional demand patterns, which include slower growth in the key markets. That said, North America, which accounts for about 1/3 of our exports from India, is presenting a meaningful opportunity with the changing global dynamics. Let's take a closer look at our performance across sectors Q3 FY25. Emerging businesses, namely tech agnostic and XEV and non-auto, contributed 24.2% of the revenue. The long-term outlook for these remains very strong. The tech agnostic and XEV business delivered a healthy growth of 9.5% on the YOY basis. Our XEV business has experienced more than 30% growth year on year on a low base. We shall continue to maintain this high growth trajectory going forward as our outlook for this tech agnostic and XEV business remains solid with an order book of rupees 5,352 million, including a major proportion from aluminum forged products. In the non-auto sector, we registered a decline of 6.6% on a year-on-year basis owing to some softness in off-road and aerospace business. Off-road segment especially, revenue stood at 203 million. Aerospace business recorded a sales of rupees 269 million. The decline here is owing to labor issues with one of our key customers, which were resolved by early November, Since then, we have seen a gradual recovery in orders from their side. Further, we have expanded our customer base and added a large European-based player to our kitty. Previously, we were working with Tier 1 suppliers of this OEM. However, now we have added them as a direct customer. We see a significant momentum in aerospace from Q4FY25 onwards. Speaking of agriculture, just as we anticipated, this business delivered a healthy growth of 65% on year-on-year basis and 75% on a sequential basis. The revenue from the agriculture segment stood at rupees 177 million, primarily driven by healthy rural demand for tractors. Our auto ICE business, which remained muted on a year-on-year basis, stood at rupees 5089 million. Our two-wheeler business grew by 7%. However, this does not show a fair picture of scooter performance, which grew much faster at a rate of 21%. For the long term, we remain positive on two-wheeler business as we expect the overall industry to grow in the coming future. As we saw channel inventory pile up towards the end of December quarter and softness in export orders, our PV business degrew by 19% year-on-year. This is in line with the overall industry scenario of slower demand. Having said that, some positive recovery is expected to come on the back of newer product launches by the OEMs. We aim to win maximum business in the newer models of our existing customers, both domestically as well as in exports market, with a focus on premiumization and critical engineering requirements. Three-wheeler business, being as the smallest in size, delivered a decent growth of 10.4% year-on-year. I would like to highlight that our CV business delivered the highest ever quarterly revenue in this quarter, growing at a healthy steady rate of 10.5% year-on-year. We have also received fresh orders from this segment, contributing to 4% of our new order range. Now let's turn our attention to our order book. As of December 2024, our order book stood at rupees 22 billion, that is 22 billion, with more than 60% of these orders coming from international market. We booked around rupees 1.9 million worth of orders during this quarter, and major order inflows are from non-auto sector, helping us to move closer towards our long-term vision. Recognizing the strategic importance of the semiconductor sector in covering everything from consumer electronics to advanced technologies such as artificial intelligence and electric vehicles, India is looking to establish itself as a global hub for semiconductor manufacturing. In line with our diversification strategy, we are also looking at this space very closely. We have won a prestigious order from a global leader in wafer fabrication equipment for supplying parts of high precision and complex machine parts to these equipments. This strategic deal comes following an extensive evaluation and selection process. This fairly large order is our first ever order in this fast-growing space. We expect our business with the customer to grow meaningfully in the next 3 years. This LOI is a testimony to our ongoing efforts to diversify into the related high-growth areas with high precision. As an engineering-focused company, we aim to deliver best-in-class solutions across multiple business areas within our playbook. To conclude, I would like to give an update on our subsidiary company, MMRFIC. The company is performing well in line with our plans. And as mentioned previously, we have further invested in the company, for which the shareholding percentage will be determined on the FY22 financial results. MMRFIC continues to make strides in the defense space and has recently emerged as a proud winner of IDEX Prime-X Challenge by the Defense Space Agency DSA for developing a 200-watt Ka-band solid-state power amplifier for satellite ground stations. MMRFIC has been awarded multiple government grants to support the development process, namely IDEX Grant 3 up to 10 crores for IDEX Prime 1, up to 1.5 crore each for IDEC DIS 2 numbers and TDF grant of up to 7 crore. We feel privileged to contribute towards Atmanirbhar program for defense and aerospace sectors, offering them all the support that we can provide in terms of experience and expertise. As through this, we also get to be part of such an industry which, as you know, is a critical aspect for the country. For a long period of time, we are confident that Sansera will continue to be a preferred choice of supplier for global giants with its deep precision engineering capabilities. Now, I hand it over to Vikas Goyal, our CFO, to take it forward. Vikas.
Thank you, Preetham. Good morning, everyone. Let me give you a brief about our consolidated financial performance during the third quarter of FY25. Our revenue from operations rose by 2% on a year-on-year basis to rupees 7,278 million. The other expenses have reduced sequentially from previous quarter and our employee expenses are broadly in line with our previous quarter. So this is the other expenses are basically a result of our continued efforts to improve cost metrics. The EBITDA for the quarter stood at 1,271 million versus 1,207 million in the same period of last year. The EBITDA margins stood at 17.5%. During the quarter, we were able to maintain our margins sequentially due to our diversified product mix, cost-saving efforts, and certain pricing actions. Interest cost also reduced on a sequential basis owing to the funding received through QIP process. That said, Q4 of this year would be even better representation of the reduced interest expense. Depreciation and amortization expenses stood at rupees 445 million, again in line with Q2. Free profit after tax margin improved on a year-on-year basis by 90 basis points, reaching 7.7%. Talking about the 9 months performance on a year-to-date basis, the revenue from operations rose by 8% on a year-on-year basis to rupees 22,351 million. EBITDA stood at 3,877 million with a year-on-year growth of 10% and a margin percentage of 17.3%. Profit after tax witnessed a growth of 12% from last year and stood at rupees 1,577 million with a margin of 7.1%. We are also happy to share that ICRA Limited has upgraded the long-term credit rating from AA- stable to AA stable and reaffirmed the short-term rating to A1+. And India Rating Limited has also upgraded our company's credit rating, long-term rating, from AA- to AA stable. With this, we conclude our presentation and open the floor for question and answers. Thank you.
Thank you, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants are requested to restrict yourselves to 2 questions. If you have any more questions, kindly rejoin the queue. The first question comes from the line of Mumuksh Mandlesha from Anand Rathi Institutional Equities. Please go ahead.
Yeah, thank you, sir, for the opportunity and congrats on the order wins in the semiconductor and aerospace. Yeah, sir. Firstly, sir, just on the growth recovery from here, this quarter, about 2% only kind of growth we had seen, which was, a little muted. So just want to understand how do you see the growth recovery going ahead here, sir?
Thank you, Mumuksh. There were a couple of reasons, as I have already stated, that while the quarter 3 generally remains a weak quarter for us among the 4 quarters, traditionally for most of the automotive companies, Now, added to that, exports, especially for Europe as well as uncertainty in US prior to the elections, saw a weak demand from the passenger vehicle industry as well. So I think that things can only get better, and we look forward for a stronger quarters and a much stronger coming year, because our order books, both by way of continued orders as well as the new products that are getting introduced, looks quite strong for the coming year as well. So we are quite optimistic about the coming year business.
So if you can share for the key segments, new segments in terms of guidance for next year, firstly on the aluminum forging, and then on the aerospace, and then on the the EV space.
Yeah. See, our long-term guidance, we have said that 40% of our business would come from non-automotive, XEV, and tech-agnostic products. Now, if you see, we have reached almost 26% in the current financial year as we speak. But then, if you really look at the stack-up that we have from the current order book to current revenue mix to adding the current order book, we will reach almost about 38% in the next 3 years' time. So our diversification strategy and focus on non-automotive, XEV, and also on tech-agnostic components have really started yielding fruitful result. Now, having said that, the most of these segments also cater to almost 60% of the business also comes from the export industry, which means that it definitely would be margin accretive. Now, just to take an example on aerospace and defense and semicon put together, because this is something that we manufacture in one common facility at our plant 9. So we have a current order book of very close to about 600 crores. Now, when I say 600 crores is a annualized full potential revenue that we have. These are contracts which have already been secured. Now, challenge would be to, unlike automotive industry, here the number of products that are involved in development are quite significant. So we expect that at least 50% of this order book would get executed in the next year. And when I say next year, it is FY26. And we expect that by FY27, at least about 500 crores or plus would get executed. Now, the risk here remains is that if there is a delay in the development of any of particular package of the products, what happens is generally customer would have to resort to the current suppliers for ordering for next 6 months to 1 year, and that could impact on the delay in starting of production. So apart from that, the orders are there, and we have put enough and more resources, including engineering resources, are being augmented, and we are preparing ourselves to deliver this order book as well.
Very clear, sir. Just also on the aluminum forging.
Mumuksh, those were 2 questions. I would request you to rejoin the queue.
Yes, sure. Thank you so much. I'll come back to you.
Okay. The next question comes from the line of Siddhartha Bera from Nomura. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. Sir, first question is on some of the newer areas which you have got good orders. So some color, if you can share, what is the size, and in the longer term, what is the quantum of revenues you think you can potentially address in the semiconductor space?
Yeah, thank you, Siddharth. As I said that this space has been we have keenly been observing, and we are being evaluated from the last 1.5 to 2 years from potential customers. Now, one of them who are the world leaders in manufacturing of machines for etching and deposition have started business relationship with us post very rigorous evaluation over 1.5 years. So these are the components which go into the machines, which are very high precision. Some of the operations that we do on a 5-axis machine, are first time in our history. While we have been on this business precision engineering for almost 35 years, this kind of machining requirements we are addressing it for the first time. It was quite challenging, but we have been able to successfully demonstrate our capability. We are also setting up a class 1000 clean room for addressing their requirement. So with all these things, we expect that we are creating a kind of very niche opportunity which can actually scale up not only with this customer as well as with couple of more slightly bigger customers as well. Now, what is the biggest thing is these customers are looking at India not for any cost advantage. Basically, they are all looking at India for because they are not able to expand for the lack of skill set that is available in either.
How do we see demand in general, if you can elaborate a bit more, considering the tariffs that might be placed on India also? And second, sir, bookkeeping question, our employee expenses increased year-on-year by 15%. So what kind of manpower are we adding here? Because the revenue has increased only by 2%. And consequently, our tax rate is also lower this quarter. But with safe to assume that it will be 25% on a yearly basis.
Yeah, the first two questions, let me answer. The trade impact of trade on India and the Indian suppliers is yet to be seen, because the reciprocal tariff is what he's talking about and the US President is talking about, but nothing has yet been formed up. They expect that a lot of these are kind of negotiation tools, and that is why I said that we would wait till end of March probably, where things would become much more clearer before one can come to any kind of conclusion on to what is going to be the effect on each country and each product category. It's too early for me to make a comment on that, so I would refrain from making any kind of comments on what is going to be the effect on this. As far as our labor cost is concerned, yes. Because it's an engineering industry and it's a high-skilled area, we will not be able to, on a short term, adjust towards big variations. We would rather carry the trained manpower, because our long-term and medium-term goals are very clear and the targets are clear. So we have focused on creating a skilled manpower, especially in the areas of high precision machining like aerospace, defense, aluminium machining, aluminium forging. These are areas which needs very high skill set. So any drop in temporary drop in the revenue, we will not definitely make a knee-jerk reaction to cut the manpower. Rather, our investment in training and skilling of these people is on a long-term basis. So in a short term, when the revenues are weaker, you would see a slightly higher percentage. But this is done keeping long-term strategy in mind.
Talking about the tax rate for the quarter, yes, it seems lower for this quarter because of certain pricing actions we did in our Sweden subsidiary, because of which we have a relatively higher profit there. And on a full year basis, this should be closer to the average for the whole entity.
It's around 25%.
Around 25%, that's right.
Thank you. So just one question, if I can squeeze in. So, what kind of revenue growth you're seeing for the next 3 years, considering this uncertainty in demand and obviously our current order book, which is strong?
See, the current order book presents a very, very aggressive opportunity for growth. But having said that, the current, auto is generally a cyclical business. And there would be once in 3 years, couple of quarters, there would be a dip in demand. There is also coupled with now, there is technology changes that are coming in. So I would still say that high teens is what we should expect over the 3 years on a CAGR basis.
Right. So with obviously sustainable EBITDA margins around 18 to 20% going ahead, considering product mix.
We would say sustainable margins. We would not put a number to that.
Yeah, I mean, the intent is to improve our margins year on year, at least by 0.5%. That is how the company is focused on working. And on a long term, 20%. Definitely a target on which we are working on. So both on ROC and margin. So that is where our long-term, vision is. So we as a company are working towards that.
Right. Thank you so much for the detailed answers.
Thank you.
The next question comes from the line of Basudev Banerjee from CLSA. Please go ahead.
Yeah, thanks, Pritamji. A few questions like I can see year-to-date capex at around 360 crore, and even a year back when we were discussing, you were looking at full-year capex of 320 crore. So maybe post fundraising, some more comfort for growth capex. And on the other side, revenue growth is low single digit. So how to look at from a strategic angle next 3-4 years your triple 20 vision of growth, margin and ROC, especially the last one, and how are you looking at the ROC factor in next 3-4 years, where venturing into semicon and EMS or other areas in the initial phase of scaling up? How do you look at as in the transitionary phase?
Thank you, Basu, and congratulations for your new innings. So, this quarter, as you said, this year or year to date, the going has been not as expected because especially in our export markets and domestic PV industry has been muted. Exports, especially in certain of our customers like off-road, have had a significant degrowth in this year, which was also expected. But then I see a very, very strong momentum. Order book is strong. New programs are quite promising. The new industries with which we are working on, like we have added Airbus as our customer directly. Our today aerospace and defense and semicon order book stands at almost 600 crores. So we are focused on making right investment into these areas. Of course, auto ICE business, which is our traditional business, there's not much of incremental investment that is going on. This is where our effort in consolidating our products at our various manufacturing facilities and harnessing that existing capacities we are working on. So Rahul, our new COO, along with his team, have been very focused on having this approach. I would definitely, you would be able to see results in the next few coming quarters of all these actions that have been initiated. I would say that on all the newer investments that we are making, especially in non-automotive sectors, both our margin profile and ROC are much better and higher than the traditional line of businesses. But of course, as you rightly put it across, few of the first initial quarters there would be a learning curve. We are going through that already because from month of October the production to these sectors have started, and I expect that over next this quarter and middle of next quarter we should be through with the first bunch of the 12 million order that we have received, and production has to start. So the things are looking quite positive, Basu.
I would like to add here, Basu, normally the capex that we incur in our business is ahead of almost 3 to 4 quarters of the actual sales realizing. So the capex that you see now is not meant for this year. It's actually going to result in revenue in the coming year. And that also takes a gradual upscale as the volumes increase on any new order. And most of the capex that we incur is actually driven by the new orders that we have.
And so the new businesses, what will be the fixed asset turn compared to the earlier traditional businesses?
New businesses should give us about 2 to 2.25 asset turns.
Okay. And last question, this year you will be ending up with how much consolidated capex?
Consolidated capex would be between 425 to 450 crores, not inclusive of the new parcel of land. That land included, it would be very close because we have invested in a very big, large piece of land, 55 acres, in the new EV estate that the government of Karnataka is creating very close to the existing Toyota facility, where a new airport is also proposed to come nearby. So I think with that we should be very close to 550 crores with the land parcel included.
And any last guidance you are giving for aerospace revenue for next year?
Next year, I already said, Basu, that we are targeting about 50% of our order book execution. Our order book is about 600 crores as we speak. So aerospace, defense and semicon put together, we expect that we would execute at least 50% of that in the next year.
And semicon will be how much of that?
To interrupt Masudev, I would request you to rejoin the queue now.
Sure.
Thank you. The next question comes from the line of Arjun Khanna from Kotak Mahindra Asset Management. Please go ahead.
Sure. Just carrying forward from Basu's question. So what is the revenues we expect from semiconductors this year?
This year, hi Arjun, do you mean the next coming year?
Right. So just to understand the breakup, while we are saying 300 crores for FY26, so FY25, what would this like-to-like number be?
I think, in our own estimate, we have taken about 60 crores as the revenue coming out of semicon in this year. But the potential to do is much higher because our order book currently is almost close to $17 million. In fact, I have been just corrected. I was telling about 12 million. We have recently received one more additional order, so it has been about 17 million. While the opportunity is slightly higher, I am being a bit more cautious because the cycle of establishment of these products and FAIs and customer also. As I said, that these also will require that we have to get into the cycle. If we miss a cycle, we would miss about 6 months of revenue. So in our current estimates, we have taken about 60 crores coming out of this.
No, right, 26. So if I look at aerospace, defense and semicon, we have said we'll do 300 crores in FY26. So this 300 crores, what would the number be in FY25 for all three businesses? Semiconductor may not be there much, but for aerospace, defense, what do we expect for closure of FY25? Hello?
Hello, sir. Please go ahead with the answer. Ladies and gentlemen, the management seems to have disconnected. I would request you all to stay online while I get them reconnected. Thank you. Ladies and
Sorry,
gentlemen,
Arjun,
management is reconnected.
Arjun, can you repeat your question?
Yeah. Right. Sir, we've mentioned 300 crores of revenues in FY26 from aerospace, defense, and semicon. Just wanted to understand what would this number be for FY25, given that most of the year is done?
We should be very close to about 140.
Sure. So we are looking at almost a doubling of the business in FY26.
If you really look at the 140, there about 8-10 crores is only coming out of semicon. So a big amount of that would get added in the next year. Plus there is a good amount of defense orders coming through, which we are getting into production. So the aerospace will have its normal growth, but that would be mostly be supported by semicon and defense.
Right. So the second question is on MMR FIC. If you could just talk about how do you look at the end game out here? So while we continue to invest, we see a new R&D facility also. So do we envisage us taking a much larger stake in the future? If you could talk about in terms of synergy benefits that possibly this partnership could represent?
Yeah, actually, see, when we looked at them, and it's been now close to 2 years since we have invested in them. So coming this March, it will be 2 years. I think in my calculation, from whatever equity that we have already put, it should result between 35-36% of holding in the current this thing. But going forward, we have the right to go up to about 51%, and beyond that, it is only whether valuation and whether we want to be, because there we need to be making sure that the promoters who are working on the projects also are interested and they have reasonably good amount of stake in the company. Now that is something on holding and the thing. But as far as the order book and the products are concerned, I understand that this they have a very, very strong now development programs that are going on. They have been working with multiple products with ISRO, with DRDO, with Indian Army. There have been 4 or 5 grants that have been given on the IDEX programs from them. And then, according to my information, their current order book backlog is in excess of 100 crores. So in that way, they are very well poised to have a meaningful growth in the years to come. and also scale it up in the products that have already been developed. And most of this would also result in technology transfer agreements once your IDEX programs are completed. So I think the future for this company is definitely in line with what we have been all anticipating, and especially they are currently, as we speak, they are also participating in the Aero Show where they have a stall, and we expect that there would be a lot of interest from the customers also coming out of that.
Sure. So just to understand, so maybe over a 3-year period, say by FY28, would you expect in terms of milestones, maybe 100 crores of turnover from this business?
Arjun, what has happened is that, yes, these are all now currently the one big project which they have been working on, which is the Radar 1, which as we speak, has been under evaluation, and it is just on the cusp of the mass production. Now we expect that the field trials to be over sometime in the next 2 quarters, and then we have already given 5 sets for all the field trials. And once this starts, there will be a very stable revenue, significantly higher revenue coming into the company, because we expect that about 150 to 200 radars is the peacetime requirement per year. So, but apart from that, there are several projects on which this thing. I am not in a position to put an exact number, but things looks very, very positive.
Sure. Sir, the final question in a...
I would request you to rejoin the queue. You're done with
right.
the question.
Thank you.
Thank you. The next question comes from the line of Sahil Kanade from Asian Market Securities. Please go ahead.
Hi, sir. This is Mayur Milak. So, 2 things here. One, the semiconductor business. So, currently, safe to believe that you're reporting it under the auto tech agnostic segment?
No, it is on non-auto.
So, it will have a separate growth pattern going forward, right?
Currently, we are reporting under non-auto because this is the facility which is combined with aerospace and defense and semicon. We have not yet started reporting it separately, but going forward, as the business achieves, scales up and reaches the meaningful thing, we will separately show, but it will be under non-auto. So under non-auto, it will be off-road, agriculture, aerospace, defense, and semicon. It will be like that.
So when you say there's a 40%, there could be a 40% kind of CAGR growth in the aerospace and defense based on your order books with Airbus and gradually the tier 1 supplier as well. The semicon will be over and above the 40% growth that you will be reporting in that space. Hello?
Ladies and gentlemen, there seems to be a disconnect from the management's end. Please stay online while I get them reconnected. Thank you.
There seems to be some technical glitch because we are connected, we can hear you guys, but then you can't hear us. So I think there was some issue. Could you please repeat your question?
Sure. So I was just trying to look at the numbers in the aerospace and defense segment that you've reported so far. It looks like this year will be a flattish year where you're saying you already have included about 50-60 crore of the semicon revenue to be added into this segment for this year. So clearly the aerospace and defense by itself would have been a negative growth territory this year. But
50-60 crores is going forward next year.
Okay. So
this year the revenue has just started, So this year we should be ending up very close to about 140 crores, 135 to 140 crores. So we will have a positive growth.
Okay. Okay. And such when you guide for a 40% kind of outlook growth in that space, that will be over and above. So the semicon growth will be over and above the growth that we will get in aerospace and defense space individually. Safe to look at it like that?
Yeah, see, basically what I said is that between 140 to 300 is what we are targeting for the next year. About 60 crores will come out of semicon. So if I remove that this year 10 has come from 140 from semicon, 130 to 240 is the growth that we expect from aerospace and defense put together. So our order book, and there is a good amount of defense orders also getting added into that. So aerospace by itself will grow by about 50% CAGR. That is the minimum that we have taken.
Fair point. So coming to the, I think a couple of guys have also asked it, but so I was just trying to look at the ratios. So clearly in the last 8 years, there are two things here, that our asset turn has always been at that 1.2 mark, and our ROCs have always been in that 11 to 12% range. Now, I believe we've already started our journey on the non-auto side and the heavy growth XEV, but some of that really doesn't seem to be reflecting into the asset turn as well as ROC. So, can you throw some light as to is there a near-term possibility of looking at a 14-15% ROC over 3 years, or do you going to be more gradual and slower than because the numbers do suggest that even in 2-3 years we should be around the 12% mark only. So just trying to work out some number on that side.
On the this ROC.
So when you say ROC, could you just elaborate how are you looking at it? Because according to at about 15% mark.
So basically, sir, I'm looking at EBIT 1 minus tax net of that.
Post-tax you're looking at?
Yeah.
We look at it pre-tax because this includes all elements. So, see, pre-tax we are targeting to reach up to 20%. So if you do a post-tax, it will definitely be above 15% over a period of time. And various actions in terms of margin improvement, in terms of diversification, and also capacity utilization improvement are some of the actions.
Sure. And on the asset turn as well, so you already pointed out that the...
Sahil, you're done with 2 questions. I would request you to rejoin the queue.
Oh, okay.
The next question comes from the line of Shashank Kanodia from ICICI Securities. Please go ahead.
Yeah, hi, sir. For the opportunity. I wanted to check upon your QIP proceeds. So, out of this 1,200 odd crores, what proportion would you be using for retiring your debt and balance for growth capex? The growth.
So Praveen, hello.
Hello.
Yeah, hello.
Yes, sir. Can you hear me? Hello.
Yeah, Praveen, could you please answer in case that our line gets cut, because you are on the line where you could hear most of it.
Sure. I'll try and do that.
Yeah.
Are you answering this question?
No, I didn't hear that.
Yes, I was just asking, sir, out of this 1,200 crores of credit proceeds, what proportion you will be using it for retirement of debt, and what proportion you will be using for growth capex, and the gross debt number as of December end versus the March numbers?
So out of the 1,200 crores, we have already retired 700 crores of debt, which was the plan as declared in the QIP document. 200 crores is going towards the capex, out of which 100 is towards the new parcel of land, and another 100 is towards some new machine equipment that we are in the process of procuring. Balance 300 crores, out of that 25 crores was the expense of QIP, and 275 crores is what we will basically be deciding in next few weeks. Mostly it will go towards growth capex and certain other developmental expenses.
Okay. So the gross debt number is roughly about 100 odd crores as of December end, because I think it was 800 odd crores as of March end, if I'm not wrong.
Gross debt as of December end Is about 350 crores because there is some debt also in the subsidiary companies which we have not touched as of now. And we are retaining some debt in the parent company, in the flagship company, because of longer period of that debt. And but on a net basis, we are negative debt.
Right. Positive cash, 500 crores of cash flow, right? Positive 500 crores of cash.
No, on a net basis, it will be about 150 crores.
Okay, net basis, 150 crores of positive cash.
Yes.
Okay. Secondly, sir, in the past on the order book side, you have been mentioning that we will take roughly 2.5 years to reach the peak revenue potential of that order book. So from roughly 3,000 crores of revenue run rate that we're doing right now, it essentially means we should be touching closer to 5,000 crores of revenues by FY27. Is it the right understanding?
I would say by 28.
Okay, so by FY28, you should be touching 5,000 crores of revenue.
Crossing 5,000, considering everything as normal.
Right. And so lastly, if you can put a timeline to your 20% EBITDA margin and ROC targets. As we have been giving this as an aspirational target, but I think we would be more concerned in what is the timeline that you're looking at attaining these 20% margins in ROC?
See, this is a two-way street. If you look at the diversification strategy and new products introduction that we are adding, and there is definitely some amount of effort and cost which is incurred in the initial phases whenever we introduce a new product line into the business. So that eats up some cost. Also, there is a learning curve when we stabilize. So while theoretically we are improving our margins on one side, on the other side we are incurring additional costs and in the learning curve to stabilize these new products. That's an ongoing process, and we believe that year on year we should still be able to sequentially improve our margins by about 50 to 60 basis points. So considering we are about 17.5% now, it should take about 3 to 4 years for us to get closer to 20%.
Right. Understood, sir. Thank you so much and wish you all.
Thank you. Ladies and gentlemen, in the interest of time, you would take that as the last question. I would now like to hand the conference over to the management for the closing comments.
First of all, let me apologize for all the inconvenience caused due to some technical issues during the call. We could have done the call without that. I'm sorry for that. And with this, I conclude this call. If you have any further queries, please contact SGA, our investment relation advisor, or us directly. And with a very positive looking next year, we end this call, and thank you everyone for joining us today for the earnings call. Thank you very much.
Thank you, sir. Ladies and gentlemen. Thank you, sir. Ladies and gentlemen, on behalf of Sansera Engineering Limited, that concludes this conference. You may now disconnect your lines.